Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Guten Tag. Welcome to Cut to the Chase. This is Daniel Lam, your host for the podcast. Well, since I greeted you in German today, let's talk about a favorite German word of mine, Zugzwang. Zugzwang. So let me quote the definition from Wikipedia. Zugzwang is a situation found in chess and other turn-based games wherein one player is put at a disadvantage because of their obligation to make a move. A player is said to be in Zugzwang when any legal move will worsen their position. Now, as you probably know, the narrative is not so bright for Europe at this moment in time. Ever since the beginning of this year, high energy prices triggered by the war between Russia and Ukraine has been the primary cause of inflation in Europe. And if you recall that in a podcast yesterday, we talked about the closure of Nord Stream 1 pipeline, how that's fueling the rise in natural gas prices in Europe. So the move by Russia in closing the pipeline is, if you think about it, putting Europe into a state of Zugzwang. So the ECB needs to control inflation, but they know that any major rate hike is going to choke off the already weak expectations in growth. If they do hike, they will be slowing down demand when it is really a supply-side issue. And of course, the European winter is approaching soon. So if they do nothing, on the other hand, inflation is likely to spiral out of control. So it's really a situation of Zugzwang for them. So why did Russia want to put Europe into this state of Zugzwang? So one of the possibilities is that Russia wants to use energy supply as a quote-unquote trump card to try to get Europe to back off from its hawkishness towards Russia over the Ukrainian war. Needless to say, most of the opinions out there is that the war is not likely to be ending soon. But if these moves by Russia were to be able to lead to the key parties coming back to the negotiation table to, quote-unquote, work things out diplomatically, then this could be a key positive for risky assets, especially those in Europe. So, like we discussed yesterday, if you're already long euro, it's probably too late to sell. So you should be focusing on the reality first and putting euro at work. Get into exporters which can benefit from weak euro, such as the European semiconductor stocks. And then you can think about your dreams, i.e. if there were to be signs of negotiations on the war, then you could consider switching into European financials, a sector that SCB is overweight on. Expectations of controlled inflation and recovery in growth is likely to be tailwinds because of the improved net interest margins for the banks. That's all from me today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.